We're delighted to have Rick today to share his view on preferred securities. Rick, how did preferred securities perform in Q1 2024? What are the reasons for the outperformance?
Preferred securities, as measured by the U.S. broad fixed income market, registered a 4.5% total return in Q1 and was the best performing U.S. fixed income asset class. In comparison, the U.S. broad fixed income market saw a negative 0.7% return over the same period. Bond yields increased notably in Q1 as a series of stronger than expected U.S. data pushed back hopes for a near-term Fed interest rate cut. As a result, rate-sensitive bonds like U.S. Treasuries and U.S. investment-grade corporate bonds declined. At the same time, U.S. high-yield corporate bonds and preferred securities posted positive returns as they benefited from the resilient economic data. Apart from this macro backdrop, preferred strong performance was also driven by their relative valuations compared to the broader market. Preferreds were one of the few U.S. fixed income asset classes to register a positive price return in Q1, as their credit spreads narrowed by 67 basis points, more than offsetting the rising Treasury yields headwind. That said, preferreds remain relatively attractive compared to U.S. corporate bonds, as the credit spread of preferred securities remains slightly below its 10-year average. In contrast, U.S. high-yield corporate and U.S. IG corporate were trading near the tightest yield spreads over the past decade, implying less room for capital gain compared to preferred securities.
How could preferred securities help navigate the changing macro environment?
Unlike traditional bonds, there is a broad range of preferred securities investors could rely on to respond to the unfolding economic conditions, which, when combined with active management, can help investors generate potential excess returns. For instance, under a hawkish Fed, rising rates in an inflationary environment, we believe active managers could first increase their position in floating rate securities. These are older preferreds that were issued as fixed to floating rate securities and weren't called on their initial call date, and therefore have a floating rate coupon. Also, these are mostly institutional $1,000 par preferreds, in contrast to the fixed for life retail preferreds. As the Fed funds rate has risen aggressively in 2022, these coupons, which reset quarterly, have also increased significantly. This has resulted in price stability amid a volatile and downward trending environment. In a period of slowing U.S. growth or recession, we would increase exposure to senior debt, also known as baby bonds. These are higher up in the capital structure relative to preferred stock, which should provide some protection against spread widening amid an economic slowdown.